as a business owner, are you taking advantage of capital allowances? Arthur Kemp of Exact joins me now to talk about the benefits of this. Well, Arthur, it's great to have you with us.
Thanks very much.
So capital allowances, for our audience who are perhaps not familiar with this, what sort of things does it entail?
So capital allowances are a tax deduction which any business entity can claim as a deduction against their overall profits or income. So typically we have individuals or companies or LLPs which own a qualifying building. And within that qualifying building there's items known as plant and machinery, which most people assume if you say plant and machinery it must be a digger or a tractor or some such. But really it's all of the second fix items that I like to think about. So it's all the heating and the lighting and the sanitary ware, etc. within a qualifying property. And we value those assets, and as part of the accounting process they get a tax deduction for those assets and mitigate their tax position.
So it's not just for business, in fact individuals such as landlords can really take advantage of this?
Yeah, so any landlord, any individual, any LLP, any limited company, anybody that has a qualifying property, as long as it has plant and machinery in it, which most properties do, then they're entitled to claim a tax deduction for that.
So can you make your residential property
it would
qualify?
It would be nice, but most people traditionally have buy-to-let properties, and in the capital allowances world you generally cannot claim capital allowances on a buy-to-let property, mainly because the whole building is deemed to be a dwelling, and you can't claim for dwellings according to the legislation. However, there are other commercial type premises that people do invest in, and for those buildings that are non-dwelling properties you're entitled to claim a deduction.
It does sound rather complicated, and new rules have just come into play as well. So what sort of things should people be aware of?
So there's some new rules which have come into play since April 2014, and very briefly it states that a capital allowance value has to be agreed between the vendor and the buyer of the property. And if that's not agreed within 2 years, then neither party can claim, or indeed any party for the future as well. So it really has identified the fact that when a property transaction happens, capital allowances really needs to be discussed at that point.
Well, this does actually seem like a really promising alternative to the buy-to-let model, because obviously the government are really clamping down when it comes to the tax benefits on that. So is it that promising? Well,
there's certain advantages to investing in other types of properties. Your typical investor now will have a buy-to-let portfolio, maybe some HMO properties. And I've heard a lot of people recently looking at other alternatives, especially with, as you say, the government clamping down on interest payments being tax deductible, and also with extra stamp duty payments. What alternative investments might be are serviced accommodation, for example, or holiday homes, both of which are great for capital allowances. So whereas currently you can't claim capital allowances on a HMO or a buy-to-let property, you certainly can for holiday accommodation and serviced accommodation as well. They get very good yields in terms of capital allowances for those. And again, it also satisfies a requirement in terms of having the interest as a deductible amount as well. So yes, there's certainly other areas or other types of investments to look at for normal investors.
But it does seem the government are really cracking down on this sort of thing. So moving forwards, do you think they'll target capital allowances?
Well, capital allowances have been around for 135 years and is actually enacted in legislation. So you can never say never. The government might look at capital allowances, but there will be an awful lot of consultation, and they can't just overturn legislation that's already in place. So capital allowances, as enacted in the Capital Allowances Act 2001, is a very legitimate type of tax relief for those people that have qualifying buildings.
So for people who are approaching this the first time, what sort of the things that they really need to know about and what to avoid?
So in terms of how to maximise your capital allowances, it's always great to have a discussion with your accountant. And we work alongside accountants because accountants are very good at general accounting, general tax relief, but they don't specialise in capital allowances. If you have had a property survey done, specifically a plant and machinery survey, then it is likely that you've had a capital allowances claim on the property. Very many people we come across haven't had a plant and machinery survey, and that's something that we can help with.
It's amazing probably how many people don't know about this and are not saving the money they should be. So Arthur, thank you so much.
Thank you.